Welcome to our Taking Stock video for the week ending the 7th of July, 2023. I'm Kien Trinh, Head of Research at Stock Doctor, and today I'm joined by our Equities Analyst Daniel Ortisi to stream to you all things share markets. Great to have you on board again, Dan.
Yeah, good to be back, Ken, and it'll be a busy week, certainly, touching on some end of financial year topics as well.
Yeah, that's right. But before we get started, a quick reminder that the information we provide during this episode is of a generic nature and shouldn't be considered personal advice. Remember, shares are volatile, and any charts or tables we present should not be relied upon as a guide for future performance. Well, this week marks another one where interest rates remain in the spotlight, and there was a sigh of relief from the Australian share market after the RBA kept interest rates on hold. Remember, rising interest rates, they can weigh on equity markets because it leads to lower equity valuations, which are based on future cash flows. Rising interest rates also raises the cost of debt and leads to lower consumer spending, which feeds into profit margins and revenue growth for many businesses. In addition, the yields on other asset classes, such as bonds and cash, they become more attractive. And with rising interest rates, this leads investors to shy away from equities.
That's right, Kian. And now we can see that the bond futures are pricing in roughly a 90% chance that the central bank will lift rates to around 4.35% by September, and the peak rate is now anticipated to be roughly 4.5%. This implies that at least one more rate hike is on the cards for Australia. Despite this, however, as you mentioned, the share market has been resilient, with the All Ords Index total return returning roughly 14.8% for the financial year. The chart on screen shows a breakdown of the individual sector performance over the financial year. The frenzy across the AI space has certainly seen the technology sector overperform, and strong commodity prices has helped drive strong returns from tech and also resources.
Yeah, even though we've got limited exposure to those commodity stocks, our Star Growth stock portfolio performed in line with the All Ords Accumulation Index. And they outperformed the Small Ords Index as well, with strong momentum emerging in the second half of the financial year. And apart from our selection of high-quality stocks, Star Growth stocks was also helped by the recovery in the growth style of investing relative to value. And you can see this with the chart on screen, with the MSCI Australia Growth versus Value Index. A rising trend line here suggests growth is outperforming value and vice versa. Now, growth stocks are recovering as investors anticipate a peak in the interest rate cycle. In addition to the AI narrative, many growth stocks have announced positive earnings updates, including those from our tech stocks like Xero, WiseTech, and also Technology One.
Yeah, the upgrade momentum has certainly been strong in those stocks, Kian. And over the financial year, the US market has performed exceptionally well, with the S&P 500 returning roughly 18% and the Nasdaq up by 25%. Those returns show the benefit of diversifying across US markets, and I'm sure Tim will be speaking about this in next week's episodes with you, Kian, for the end of financial year edition of Taking Stock. Meanwhile, Star Income stocks also had a great year, rising by roughly 14%, despite the lackluster returns from high-yielding sectors such as staples, property trusts, and financials as well.
Yes, Dan, a great result for Star Income stocks, also especially with the weak sentiment across some of those high-yield retail stocks as well. But moving forward, we cannot be too complacent. The economy is in a fragile state following a raft of interest rate increases, ongoing cost pressures, and also slower economic growth. Over the last 6 months, earnings expectations have been revised lower, and this is shown with the chart on screen, which compares earnings expectations in black to the All Ords Index in blue. And forward indicators such as business surveys and manufacturing orders all suggest that more downgrades are expected to come, especially as we head into the full year reporting season. Hence, it's important for us to focus on risk management. Invest according to your stage of life. Maintain a well-diversified portfolio of financially healthy businesses. And make sure you understand the active risks of the stocks in your portfolio and monitor changes to the outlook by keeping track of those earnings revisions. And you can do this also using our alert tool. I understand the Lincoln funds are also positioned quite defensively with cash on the sidelines to take advantage of opportunities in the next reporting season.
Yeah, that's right, Kian. And also another reason for that negative trend in earnings from that chart just shown on screen has been the negative revisions across the resources sector. Commodity price assumptions have been tempered, especially following the weaker than expected economic data out of China. For example, the local Chinese services PMI data has been contracting to 53.9 points in June compared to 57 points a month earlier.
Yeah, that sector can be quite volatile, but we'll keep a close eye on those resource stocks, especially with regards to the earnings revisions and the sustainability of those dividend yields, which remain well above the market average, such as those from BHP, Woodside Energy, and Rio Tinto. Now, moving on to our star stocks, borderline star growth stock, Johns Lyng. They were back in the news this week, this time with a capital raising to help fund Smoke Alarms Australia and Linkfire for an upfront consideration of around 62 million. Both these businesses are involved in the home services and strata management market, which should complement Johns Lyng existing operations in Australia. However, the deal is relatively small at roughly about 5% of Johns Lyng's market cap.
That's right, Ken. And reading from the announcement, clearly management believe that the deal will boost FY24 earnings by roughly 5%. And after accounting for synergies, could be even higher than that. But it was interesting to see that the company decided to raise capital, given that they had enough cash on the balance sheet for this acquisition of this size. Perhaps they could be planning for future acquisitions down the track.
Yeah, that's interesting. But the stock is trading at a significant discount to consensus price targets. But even before considering the stock as an opportunity, investors should really be comfortable with those active risks. For example, if forecasts of El Nino come true, then the financial year 23 could represent a peak in the earnings cycle because there will be less claims from flood-related events. But looking at the outlook, they look still pretty strong for Johns Lyng at this stage. And also speaking about those active risks, Dan, let's take a look at superannuation services platform Link Administration. The company's share price was sold off quite heavily over the past week after superannuation fund Hester, they failed to renew their contract worth an estimated of around about 4% of the total revenue.
Yeah, that's right, Ken. And members would note that Link has been financially unhealthy for the past 3 periods, and that appears to be driven by the elevated levels of debt relative to the company's tangible assets. Furthermore, whilst return on equity looks to have grown into more acceptable levels, we do question the sustainability of that double-digit ROE, given the number has been inflated by recent impairments of intangible assets.
Yeah, with the unhealthy financial health, this stock is very high risk, and you can see that with consecutive periods of share price declines. The stock does look like it's trading at significant discounts to fair value of around 26% discount here, but income-seeking investors may also be attracted to that gross dividend yield of 7.5%. But remember, volatility in this share price may lead to capital erosion and offset some of that dividend income as well. So we believe this stock has the characteristics of being both a value and yield trap. That is a stock that has significant risks, which could lead to further earnings downgrades and impairments down the track. So just be very careful with these stocks, which are financially unhealthy businesses.
Yeah, finally, Kien, those who are looking for alternatives in this space may also consider a company like Computershare, which is obviously a borderline star growth stock and found in the peer comparison table below. Onto the corporate calendar for the week ahead. It will be another quiet one on the events front, with no companies anticipated to go ex-dividend or announce financial events.
In Under the Microscope this week, we'd like to highlight an emerging opportunity called XRF Scientific. The company provides technology to analyze mining and chemical samples. And over the last few years, it's been a very profitable business, now generating a return on equity at 17% and net profit margins close to 14.5%.
Yeah, that's right, Ken. And certainly from a financial health perspective, the business does have a strong rating. And it also does have a net cash position. And furthermore, has increased its operating cash flows by roughly 31% from the prior corresponding period. Now, the outlook under Golden Rule 3 suggests that profitability metrics are expected to continue, although we do note there is only one covering analyst for the stock, so potential investors will need to review the management guidance and conduct their own due diligence to ensure these forecasts are somewhat reliable.
Yeah, and that also applies to the consensus share price valuations as well, with only one analyst there as well. But before considering this opportunity, investors should really be mindful of a few risks as well. And under Golden Rule 6, the stock has a daily average trade value of around 260,000. And so this may only be suitable for those wanting to take a modest position in the stock. In addition, management holdings seem quite minimal and do not reflect really a strong alignment with shareholders.
Yeah, we also want to highlight that XRF's most recent investor presentation, management seemed to express their intention to pursue further M&A opportunities. And as the company only has a roughly $3 million net cash position, there is a potential risk that it may need to raise capital to facilitate any acquisition-related growth going forward.
Yeah, very good point, Dan. And emerging opportunities can be great ideas, but also comes with these risks. So to look for these opportunities, you can refer to Tim's growth or income filter with potential, or create your own. As always, members are encouraged to conduct their own due diligence and also determine if these stocks are suitable for them. With the new financial year upon us, a useful question, especially for newer members, is how can investors construct a portfolio from Stock Doctor's Star Stock universe?
Yeah, the first step is certainly to determine your overall investment objective and tolerance to risk. Once you have determined your ideal allocation to equities, you could identify whether you are a growth or an income investor. To help members ascertain the type of information and investor that they are, we highlight a powerful feature of Stock Doctor, which is the Portfolio Constructor and Optimizer tool.
Yeah, to access this feature, just click on the Portfolio Constructor button within the Portfolio Manager. Follow the instructions in the pop-up window to narrow down on your investor profile. And if you are uncertain where to begin, please click on the Investor Profile Calculator.
And then next, you can indicate whether you are sensitive to share price falls. For example, if you are trend sensitive, the Stock Doctor tool will only recommend stocks which have not triggered an exit on the SD30 TSR or SD Max. Finally, you'll be given a list of star stocks. Here it is important to select stocks you are comfortable with. Make sure you go through the golden rules and read the analyst commentary, especially around the outlook and active risks for any company. Also, feel free to call our analyst research team if you are unsure about any stocks or just want to have a discussion in general.
And once you have your portfolio set up, you can use the Portfolio Optimizer to help you rebalance your portfolio over time and provide you with new ideas. The Portfolio Optimizer uses a powerful algorithm to come up with a list of suggestions to maximize the return to risk, considering your investment objectives and also your existing holdings in the portfolio.
And finally, Kien, if you do want to replicate the performance of our star growth or star income stocks, then you can simply decide to hold all of the stocks within your portfolio, but make sure you are setting up alerts so that you're sent reminders when there are changes within our star stock universe.
Yeah, and there will be plenty of star stock changes during the reporting season, Dan. But that's all we have time for today. Thanks again for your insights.
Good to be here again, Ken. And like you mentioned, certainly busy with the upcoming reporting season.
Yes, and if you have any questions with today's episode, feel free to contact our analyst team or even participate in our Lincoln Live webinar this Monday. But to summarize, the 2023 financial year has been a great one for equity investors. However, we cannot become too complacent. With earnings revisions moving lower, it's an opportune time for you to reassess your portfolio to ensure you don't have any high risk stocks, especially those unhealthy businesses lying in your portfolio. And the powerful algorithm used in Stock Doctor's Portfolio Optimizer can help with alternative suggestions. Have a happy, healthy, and prosperous week ahead, everyone.